Senator Toomey. Ranking Member Toomey.
Thank you, Mr. Chairman. Chairman Gensler, welcome back to the committee. Good to see you again. The SEC, as we all know, has a critical role to play in protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation. Unfortunately, some of the SEC's recent actions and inactions raise concern about how well it's carrying out this important mission. Take, for example, the SEC's handling of crypto lending platforms like Celsius and Voyager. Celsius and Voyager were offering interest rates as high as 18% if customers would lend their digital assets to them. The firms would then lend that crypto to presumably other larger investors to make short-term bets on crypto markets. But once the crypto sell-off began, many borrowers couldn't pay their debts, and these platforms froze customer accounts. The SEC did take enforcement action against BlockFi for similar activities last winter, yet somehow let Celsius and Voyager continue through this spring when both companies blew up and found themselves in bankruptcy, with investors staring at billions in losses. Where was the SEC? And where's the SEC been in clarifying the rules of the road for crypto market participants? The chairman insists in his written testimony that, and I quote, the vast majority, end quote, of crypto tokens are securities. But he's also acknowledged that Bitcoin is not. Now, presumably, that's because Bitcoin is so thoroughly decentralized. But that naturally raises the question, where on the decentralization continuum does a token cease to be a security? Now, most of these tokens don't even have a financial claim on the issuer. Doesn't that make these tokens very different from at least the vast majority of ordinary securities? And if the chairman is right that most tokens should be considered securities, then as he himself states in his written testimony, and I quote, it follows that many crypto intermediaries are transacting in securities and have to register with the SEC in some capacity, end quote. But crypto transactions typically can be settled in real time on chain and without intermediaries. As a result, crypto intermediaries often serve different customer needs, they've got different business models, and they pose different risks than traditional securities intermediaries. All of that raises the question, what is the crypto-specific roadmap for these crypto intermediaries to register? Stepping back, I think there's a larger problem here. As Bloomberg columnist Matt Levine put it, and I quote, Chairman Gensler's posture is that he should be in charge of writing the rules for crypto, but not write them. I just don't see how that can work, end quote. I think Mr. Levine has a good point. Given the novel nature of these tokens, really Congress ought to step in and provide clarity. In particular, we need to revisit the definition of security as part of a larger effort to tailor a regulatory framework that is calibrated to the unique risks and activities of the crypto market. As I've said, crypto tokens have varying degrees of decentralization. They usually do not have a financial claim on the issuer and typically can be settled in real time without intermediaries. These are very major and important differences from traditional securities, and they merit a clearly stated and tailored regulatory framework. Now, while the SEC has failed to provide the regulatory clarity in the crypto markets, it's been issuing numerous controversial and burdensome rules and proposed rules in the ordinary securities market. Top of that list is the SEC's climate disclosure rule. Public companies are already legally required, to disclose material climate change information. The proposed rule, however, would go much further to require disclosure of exceedingly extensive global warming data. Now, this data will be enormously expensive to collect, but almost none of it will be material to a business's finances. For annual reports alone, the SEC estimates that aggregate external compliance costs for issuers will increase from $1.9 billion per year to $5.2 billion per year if the SEC's proposed climate disclosure rule becomes effective. The SEC itself, again, estimates that the external compliance cost of a company going public will increase by more than 5 times at a time when excessive regulatory costs are already resulting in ever fewer companies going public. The cost of compliance will be more material to the investor than the information itself. But, of course, the climate disclosure rule isn't really about informed investment decision. It's about equipping climate activists with data to run political pressure campaigns against companies, which will often be to the detriment of shareholders. The end game is to discourage capital investment in oil, in natural gas, and other traditional energy industries, and we've seen how well that's working out in Europe. The SEC is wading into controversial public policy debates that are far outside its mission. and its expertise, and they're doing it without the legal authority to do so. And in the process, the SEC risks politicizing the agency, slowing economic growth, increasing inflation, and possibly even undermining national security. So given the importance of these issues, Banking Committee Republicans have written to the SEC asking basic questions about how the SEC developed the climate disclosure rule. Instead of providing real substantive answers, the SEC has been stonewalling us. Well, the SEC may not want to answer to Congress on its climate disclosure rule, but ultimately, the SEC will have to answer to the courts, which should make it nervous. The Supreme Court has repeatedly held, and I quote, "Congress does not alter the fundamental details of a regulatory scheme in vague terms or ancillary provisions. It does not, one might say, hide elephants in mouse holes," end quote. This summer, the Supreme Court applied this sensible principle in the West Virginia versus EPA case. There, it ruled that the executive branch and its agencies cannot use novel interpretations of existing law to pretend that they've got a legal authority to support sweeping policy changes, including on climate change, that Congress never intended. Well, that's precisely what the SEC appears to be trying to do with its climate disclosure rule. The SEC should consider itself to be on notice by the court that the separation of powers still exists and will be upheld. Thank you, Mr. Chairman.
Here comes Toomey's 5 minutes.
Ranking Member Toomey.
Thank you, Mr. Chairman. Chairman Gensler, in your written statement, you acknowledged, as you have in the past, that there are some tokens that are not securities. And I know your view that whether or not a digital asset is a security is a facts and circumstances analysis. I know your view that the SEC has very broad authority. But you've also made it clear in the past that Bitcoin is not a security. Now, some SEC staff have also previously said that Ethereum is not a security. The SEC's Dow report characterizes Ethereum as decentralized. So here's my question briefly, and without getting deep into the weeds on this, and I acknowledge your belief that most tokens have a large degree of central control, but generally speaking, is it fair to say that a significant factor for you in whether or not a digital asset is a security is whether it is centrally controlled or decentralized?
Well, I look to the Supreme Court that's often written about this, probably close to a dozen times in 50 years, and it's whether the investing public is anticipating profits, and that includes anticipating profits from appreciation as well as from, as you mentioned, rights, based upon a common enterprise, but
Right.
the efforts of that common enterprise.
Right. So I guess another way to put my question, which you haven't answered, is it possible to have a common enterprise if it's something is decentralized? How could I have a common enterprise? I mean, it doesn't isn't centralization necessary to constitute a common enterprise?
You could have some things that are quite open, but still have, if the public is anticipating a profit based upon that common enterprise. So I'm being careful with my words here to be accurate as best I can. The common enterprise, are you relying on a group of individuals? And look, these are not laundromat tokens. There is a group of people that are actually...
You're not answering my question, though. But so let me try it this way. What is it about Bitcoin that causes you to conclude it is not a security?
Well, one is there's no group of individuals in the middle.
Right. It's
there's
decentralized.
no group of individuals in the middle.
Right.
That are basically, and you're not, in essence,
So-
the investing public's not betting on somebody in the middle or six people in
So
the middle.
you're choosing not to use the term decentralized, but that's what you're describing. It is the decentralized nature of Bitcoin, I think, is really what you're getting at. Here's my point, and I'm going to run out of time here. But there are a lot of projects, as you know, decentralization and centralization occurs on a continuum, really, I think. And you've acknowledged that there are tokens, plural, that are not securities. I think it's because of this centralization that you come to this conclusion. And my point is, it is not reasonable to fail to provide clarity, to provide the definition of exactly where on this continuum you have a sufficient common enterprise that it qualifies as a security and where you don't. You've said Bitcoin doesn't. Some of your colleagues have said Ethereum doesn't. But a reasonable developer who wants to comply with this doesn't know where that line is drawn.
So I think where we might have a difference is there are many factors, and so it's not one spectrum of centralization versus decentralization. What the Supreme Court, and I try to stick to, they're the Supreme Court, and there'll be debates about other laws. I try to stick to what they say, a common enterprise. I think about a group of individuals in the middle. That developer is in the middle, and the investing public's betting on them, counting on them, even if the token might be on 1,000 computers. That's not what the Supreme Court's looking at. It's not about the token being on 1,000 computers. It's just like a group of developers in the middle.
But if there is nobody controlling it in the middle, that's what we call decentralized, and that does happen. As you know, of course, the Howey test requires all four of the tests to be met in order for something to be defined as a security. Let me move on to another related issue, which is, as I said in my opening statement, I don't think that the SEC has provided a crypto-specific roadmap to the registration of crypto intermediaries. One example of the problem that arises is the SEC's customer protection rule was written in 1972 and doesn't address how a broker-dealer should hold a customer's blockchain private keys, for instance. Now, I know the SEC claims to have provided relief, but the relief has very onerous contingencies. It's time-limited, and my understanding is few, if any, broker-dealers have been able to comply. So I know you've said many times you want to have the industry, the intermediaries, come in and have a conversation with the SEC about this. But wouldn't it be better if the SEC came out and laid out how you would apply the rules and regulations to these novel devices?
So we're in conversations with a number of these intermediaries across the exchange, the lending, the broker-dealer, the custody space. As I've said a year ago, in the lending space, people should make no mistake. And I think it sounds like, Senator, you and I might even agree that the lending platforms are under the securities laws.
Right.
But in the exchange space and the broker-dealer space, I accept that people have not come in and used what was put in place under Chair Clayton, that broker-dealer custody rule that you mentioned. And so I've said to staff, let's use everything in our regulatory toolkit, whether it's exemptive orders and others, to help facilitate and get this industry. People will not have trust in this space unless it comes into investor protection.
So I'm out of time, Mr. Chairman. So I would just say my concern is that the approach you're taking with these one-off discussions, if it did even result in an opportunity to comply, it'd be this idiosyncratic exemptive order negotiated with a single company. And that's not a good way to pass rules. It ought to be through the APA and a very public process.
If the chair would forgive me, I think we've been very clear through 70 or 80 actions, starting with that Dow order, the Munchie order, and many others, and they were full votes of the commission, they're not just staff. Secondly, I just look at other times in the history, the SEC and the asset-backed securities market took 10 or 11 years where they did these, as you would say, exemptive orders or relief to individual issuers, and did a rule at the end of that 10 or 11 years based upon all that experience. So we actually believe it's worthwhile to talk to the industry, talk to the market participants, and get them registered.
We believe that it is those that raise the money through an initial sale of digital assets and those that continue to provide essential managerial efforts should be held responsible.
Okay, so I'll talk a bit about the funding model. So we will have a fundraiser for 2 months starting February 1st. It will be available at funds.ethereum.org.
Section 301 of our bill provides for robust technology-neutral disclosure obligations that would hold responsible those who benefited from that fundraising.
So the idea is that part of the initial issuance will be 1,000 Ether for 1 Bitcoin, or up to 2,000 Ether for 1 Bitcoin if you get in early to compensate for the increased risk. So the issuance model is that we will suppose that we hand out X Ether through the fundraiser.
But the entrepreneurs, the sponsor, the promoter, the entrepreneurs, that's where the disclosure obligation ought to be.
Then there will be about 0.5x will be pre-mined, and then 0.4x after that will be mined per year forever. So it's this hybrid of the Mastercoin and Ripple model and the pure Bitcoin mining model